Everything you've been told about diversification is incomplete, and it could cost you a lot of money. I'm Clark Atterbury, and after helping clients to manage their investments and work toward their retirement goals for over 30 years, I can tell you something. Most diversified portfolios aren't and could get crushed in the next market downturn. A prospective client sat down with me not long ago. He was proud of his portfolio. He said, I'm in a diversified portfolio. I own 8 different stocks. He had Apple, Microsoft, Google, Amazon, Tesla, and a couple of bank stocks. He thought he was playing it smart. But here's what can happen if the markets have a downturn. All 8 of those stocks could be down at the same time. You see, he thought he was diversified. He owned 8 different stocks, but what he didn't realize is that they were all concentrated in one type of investment, large American stocks. Now, if you own 8 stocks, or maybe a mutual fund, or even a collection of a few mutual funds, you might think you're diversified too, but you're probably not, as we'll discuss in this video. Before I share the solution, let me ask you something. Consider your current investment portfolio. How many different types of investments do you have? Are you in the 8 stocks camp, or do you have a mutual fund, or maybe an assortment of a few random mutual funds? Let us know in the comments below. I'd be curious to know where you're starting from. Let me help you to understand what real diversification actually looks like. I want you to imagine a pie, a circle on the table in front of you. For the purposes of this illustration, we're going to cut that pie into many different slices, and each slice is actually a different investment market. People ask me all the time, Clark, how was the market today? And what I want to say is which one, because while most of us, we hear about the Dow or the NASDAQ or maybe about international, the fact is there are many different markets. And one of the key ways to diversify is to diversify among different markets, as I'm about to explain. One way to diversify a stock portfolio is among different market capitalizations. If you've got a 401k or an investment portfolio, you might see on the menu large cap, mid cap, small cap. CAP stands for capitalization. Capitalization just means what is the value of the corporation. For example, if Clark Inc. were a corporation, let's say I had 100 shares of stock in circulation and they were trading at $5 per share. My market capitalization would be 100 shares times $5 per share, $500. Like I say, it's a pretty simple concept with a big fancy name, capitalization. One of the things to achieve when diversifying a portfolio is to have your different kinds of investments have, to some extent, low correlation to one another. Another fancy term of the simple meaning, correlation just means, do they behave the same way at the same time or not? If they have positive correlation, one's up, they're all up, down, they're all down. But if they have low or negative correlation, that means, well, if one's down, maybe something else is up at the same time. And that can reduce the overall volatility of the portfolio as a whole. So we're going to apply that concept initially to different market capitalizations by having one slice of the pie be large cap stocks, another slice of the pie be mid cap stocks, another slice of the pie be small cap stocks. We are diversifying among 3 different markets and to some extent having low correlation to one another. Another way to diversify a stock portfolio is to invest in funds that have different styles. There are growth stocks and there are value stocks. They also have some degree of low or negative correlation to one another. They tend to not march to the same drummer at the same time. Keep in mind this isn't a perfect science and that there are periods where everything is down or everything is up at the same time. But generally speaking, the strategy is to diversify among different kinds of investments that usually have some degree of low or negative correlation to one another. Another way to diversify a stock portfolio is to diversify geographically. When I was a kid, 75% of the world's stock market capitalization were American companies. The rest of the world accounted for 25%. Well, guess what? That's different today. It's basically flipped. Now, 75% of the world's stock market value or capitalization is outside of the United States. 25% is in the United States. So that's something that's on the menu for you to consider, perhaps having a slice of the pie be in non-American companies. And again, we're looking for low correlation. So perhaps the American economy is having an off period and other parts of the world are having an up period of time. So back to the pie concept. Imagine that circle on the table in front of you with different slices on it. One slice, large cap American growth stocks. One slice, large cap American value stocks. One slice, mid cap growth. One slice, mid cap value. One slice, small cap growth. One slice, small cap value. One or more slices in some kind of international stocks. Okay, so now we've got the stocks diversified among different markets, many different types of stocks, different slices of the pie. Let's talk about another way to diversify the stocks, all those stocks with different kind of investments. I'm talking about bonds. Bonds typically have low correlation to stocks. So if the stock market or all these different stock markets should be off at one point in time, it wouldn't be surprising if the bonds were up. And again, reduce the volatility of the portfolio as a whole. One of the ways you can diversify among different bond markets is by having perhaps one slice in long-term bonds, maybe another slice in intermediate-term bonds, yet another slice in short-term bonds. One reason that it's important to diversify among bonds of different maturities is that they tend to behave differently when interest rates change. Long-term bonds are affected the most if interest rates go up or down. Short-term bonds are affected the least by interest rates going up and down. And so depending on what interest rates are doing, you might want to be shifting from long-term bonds to short-term bonds, or short-term bonds to intermediate-term or long-term bonds. You can also diversify amongst different credit qualities. Just like you and I have FICO scores, and if I have a higher FICO score than someone else, I'm going to get a better interest rate. I have to pay less interest to borrow money. Same thing's true with these corporations or governments that are borrowing money by issuing bonds. They're rated by companies like Moody's or Standard & Poor's, who assign these different corporations or government entities credit ratings. Just like there's a continuum of FICO scores that go from the very worst, tick, 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 all the way up to the very best, similarly, with credit scores for corporations and governments, they have a continuum also from the very worst credit rating up to the very best. The very best, the tip-top zone, they call investment grade bonds. Everybody else they call high-yield bonds, sometimes referred to as junk bonds. So back to the concept of the pie, that circle on the table in front of you. It's been sliced up into many different slices. Each slice, whether it's large cap growth, large cap value, or international or high yield bonds, etc., the pie has been sliced up. How much is in each of the different slices of the pie depends on what type of an investor you are. It depends on your time frame, your tolerance for fluctuation, your tax bracket, what other resources you have, and what are your goals. So I'm not saying if you have 12 slices in your pie, you should put equal portions into each of them. That's something you'd want to be thinking about depending on your goals, what's going on in the world, what's going on in the financial markets. It's a strategic decision to decide what percentage you're going to want to have in each of those different slices of the pie. If you know what you're doing, you could build out that portfolio yourself. A lot of people feel there's a benefit of working with a financial professional who can do all this for you. Okay, so now we've got this pie. Our portfolio is diversified among many different slices, many different markets. That's a good start, but we're not finished. We're not going to own a few stocks that are large cap growth, a few stocks that are large cap value, a few international stocks, a few different types of bonds. That's still not diversified enough. Now that we've diversified among the different markets, the different slices of the pie, what we want to do next is to become very diversified within each slice of the pie, within each of those different markets. What I suggest is that you own many different index funds. You own an index fund for each slice of your pie. That way, each slice of the pie or each different market is itself very diversified. That's what an index fund allows you to do. If you look under the hood, if you own an index fund in your large cap growth slice, you look under the hood or under the crust of that slice of your pie, you're going to go, oh, I own 500 different stocks here. Or maybe it's 1,000 or more. You look under the large cap value, oh, I own 500 or 1,000 different stocks there. Mid cap growth, mid cap value, small cap growth, small cap value. Each of the different markets is beautifully diversified itself. This is a time-tested strategy that has historically reduced the risk of owning a portfolio of stocks. So how do you accomplish this? It's not as hard as it sounds. You can go to companies like Vanguard, Fidelity, or Schwab. They have index funds for each of these different types of investments. How much do you put into each of the different slices of the pie? Again, that depends on who you are as an investor, your time frame, risk tolerance, investment objectives. But the key is you're not putting all your eggs in one basket or even 5 baskets. You're diversifying your investments among many different markets and in turn within each of those different markets, ultimately owning hundreds or thousands of different investments. Now here's something important. Once you've decided what percentage of your money is going to go into each of these different slices of your pie, that's not the end of it. If you're managing your own investment portfolio, you're going to want to tend the portfolio, depending on what's going on in the world, what's going on in the financial markets, what are the things that are affecting interest rate changes, terrorist attacks, God forbid, whatever's going on that has some impact on how those different kinds of investments are performing. If you're going to tend your own portfolio, you're going to want to follow all this and periodically perhaps make some changes to the mix or the allocation of your portfolio. Now here's the thing, you can absolutely go and do this yourself without the help of a financial advisor. Our clients are smart enough that they can go out and build this portfolio for themselves, decide how they're going to invest it today, watch what's going on in the world, follow the markets, follow the news, make periodic adjustments to the mix of their portfolio. They could do that themselves. But here's what I've learned after over 30 years of doing this for clients. Even though they're smart enough to do this themselves, they realize that their time is their most precious resource. And they have other things they want to do. Spend time with their family, follow their passions, travel, whatever is important to you, how to use the precious amount of time that we have left in our life rather than following the markets and watching what's going on, doing all this themselves. And they find there's a value in having a financial advisor build a portfolio and tend it for them over time. So let me ask you again, when you look at your current investment portfolio, do you currently have a really diversified portfolio? Or do you have a few stocks, or maybe a mutual fund or an assortment of mutual funds that tend to behave the same way at the same time? If you're the kind of person who wants to do this yourself, I've given you the roadmap. I hope it helps you. But if you're the kind of person who values professional help, I'd love to have a talk with you. I'll leave a link in the description below. You can click on that to schedule a no-cost, no-obligation consultation, phone call, video call, whatever works for you, to see how we might be able to help you. For more straight talk on investing and retirement planning, watch these videos next.